The RBI just hit pause. Again, the repo rate stands frozen. The Reserve Bank of India has just announced its latest monetary policy, and as widely expected, the repo rate has been kept unchanged at 5.5% and GDP growth estimates at 6.5%. But why did the RBI make this move? And more importantly, what does this mean for your investments, the stock market, Nifty, Bank Nifty, and specific sectors? So, welcome back to my channel Market Insights by Rajesh Sharma. In the next 10 minutes, I'll break this down in simple terms with crisp analysis and actionable insights. So, if you are an investor, trader, or just curious about the Indian economy, don't miss it till the last. If you are new to my channel, please like, share, and subscribe, and share it with your investor community. Let's start with RBI's key announcements. Repo rate unchanged at 5.5%. The stance remains withdrawal of accommodation. So it is now in no mood to accommodate through rate cuts. So for the time being, it is withdrawn that accommodation mode. Inflation, especially CPI, remains a concern. India's growth forecast is strong, real GDP projected at 6.5% plus. RBI remains data dependent, cautious due to geopolitical risks and food price shocks. So clearly, the RBI has chosen stability over stimulus for now. But the tone is cautious, thanks to the rising CPI inflation and geopolitical tensions. This tells us the RBI sees growth as healthy, but inflation is the red flag. Many were hoping for a cut, but here's why the RBI did not blink. So, why is the RBI hitting a pause even when the global central banks are leaning towards rate cuts? Well, inflation is still sticky. Food inflation, especially in vegetables and pulses, is rising. Crude oil is hovering around $85 plus, and with Middle East tensions and supply chain issues, it could spike even further. Global uncertainties, Ukraine, Red Sea disruptions are making the RBI cautious. And these are not just local risks, but their impact on inflation, rupee, and trade is very, very real. Cutting rates now could risk a second inflationary wave, something the RBI clearly wants to avoid. Unlike the West, which is tiptoeing towards easing, India is in a wait and watch mode. Despite global chaos, India is holding strong. From an economic standpoint, here's the good news. India's growth engine is still running strong. GDP growth remains on track. Credit growth remains robust, means banks are lending and businesses are borrowing. Urban demand is stable. Rural demand is slowly improving. Capex by government and corporates is gaining pace. However, Loan EMIs remain elevated, which could impact consumption in interest sensitive sectors like the housing, auto, and SME credit. But overall, India is showing resilience, and that's a positive aspect. Now, let's talk about markets. Nifty 50 may stay in a range bound zone for a while. Why? No RBI trigger, rich valuations, and global noise keep things very tight. Valuations are rich. Investors are watching Fed moves, crude, and inflation prints. Bottom line, we may consolidate, but that's not being bearish. It's a time for stock picking and improving your portfolio. As for Bank Nifty, it is slightly more vulnerable. Credit growth is good, but no rate cut means pressure on net interest margins. The PSU banks like SBI may outperform private banks in the short term due to strong balance sheets and government backing. A divergent bank trade might emerge here. Overall sentiment cautiously bullish, but with limited upside until we get rate clarity. Some sectors could benefit or lose from the status quo policy. Let's break it down. We can see positive bias in IT, which is rate hold, stable rupee, better margins, plus global tech recovery. FMCG, rural demand recovery, plus softening agri prices, which is equal to better volumes. Capital goods and infra, government capex push continues. Cautious view on real estate due to high EMIs continue to pinch home buyers as it is a affordability concern for them. Auto, two wheelers or four wheelers, rural demand is improving, but it is not yet a boom. NBFCs, no rate cut equal to higher borrowing cost pressure, which is hitting their profitability. Here, interest rates matter, and flat rates means flat momentum. Now, here's what you have been waiting for, some stocks to keep on your radar. If you are looking at the financial space, keep an eye on ICICI Bank and SBI due to robust balance sheets, strong credit growth, stable asset quality. L&T, it's a infrastructure player, strong order book, benefits from government capex. Hindustan Unilever and ITC, FMCG giants benefiting from improving rural demand. Infosys and TCS, IT recovery plus rupee stability plus improvement in global IT spends is considered as a tailwind for them. Ultratech Cement, capex plus infra plus demand uptick ahead. Remember, these stocks are just not tips. Do your own research, but these names are sustainable compounders and fundamentally aligned with the current macro themes. So, to conclude, let us wrap it up. The RBI is in a wait and watch mode. Inflation is the villain here, but RBI is laser focused on inflation. No rate cuts can be seen soon, but that's not a negative for a resilient market like ours. India's economy is resilient. Sectors like IT, infra, FMCG look interesting. Markets may consolidate, but it's a time to build your watch list and just do not panic. And that's your last chance to research and plan. The RBI is playing it smart, not hasty. Inflation is the beast and stability is the sword. As investors, we must adapt, look for quality, understand the macro, and ride India's structural growth story with patience. So, what is your action plan? Stay invested in quality and not just momentum. Focus on earnings, visibility, and stability, and manage risk because global uncertainties are real and here to stay. So, if you found this breakdown and insights helpful, do like, subscribe, and share this video with your friends and the investor community. Drop a comment. What's your outlook on the markets after this RBI policy? I'll see you in the next one. Thank you. Bye bye.